we are ready to talk about how the Fed can use those three traditional monetary policy tools to conduct monetary policy. That is, to control the quantity of money supply in the economy. That is, how can the Fed use these three traditional monetary policy tools to control the liquidity of the economy? The first traditional monetary policy tool is the required reserve ratio. How does it work? If the Fed announced that they're going to increase the required reserve ratio, that means commercial banks will have to keep a higher portion, a bigger portion of the deposits that they received in their vault or in the Fed's reserve account. Therefore, they got less money to loan out. And remember, commercial banks create money by making loans. If they got less money to loan out, they create less money. The second one is the discount rate. Remember, the Fed sets the discount rate on the discount loan that the commercial banks borrow discount loans from the discount window. If the Fed raises the discount rate, then that will increase the cost for the commercial banks to borrow reserve from the Fed. That discourages commercial banks to borrow reserve from the Fed. Therefore, they have less reserve to loan out. Therefore, when the Fed increases the required reserve ratio or the discount rate, then banks' lending decreases. And banks create money by making loans. Therefore, commercial banks' ability to create money decreases. Therefore, money supply decreases. The third one is the open market operation. How does it work? Okay, this is very, very important because this is the monetary policy that the Fed is conducting on a daily basis. Remember, the Federal Open Market Committee meets every 6 weeks. What are they talking about? They make a decision on the targets of the federal funds rate. So the result of that meeting is announcing a target of the federal funds rate. So what is the federal funds rate? Federal funds is the reserve. Okay? So federal funds rate is the interest rate on reserve. On what reserve? If the commercial banks is short of cash, if the commercial bank is short of reserve, they need some cash to pay the depositors. If they are short of reserve, they can borrow reserves. How can they borrow reserves? Two ways. They go to the Fed to borrow reserve from the Fed. Where do they go? The answer is they go to the Fed's discount window to borrow discount loan and pay discount rates. Alternatively, they can also borrow reserve from federal commercial banks. Where do they go? They go to a market called Federal Funds Market. This is the market where commercial banks go to borrow and lend reserve to each other. So the Fed is not involved. Okay? Therefore, federal funds rate is a market interest rate. It is the interest rate that commercial banks negotiate with each other. So this is a market interest rate. Therefore, the Fed cannot set federal funds rate. They can only set a target of the federal funds rate. So again, what is the federal funds rate? Federal funds rate is the interest rate that commercial banks charge each other for borrowing reserves. Then what is the discount rate? Discount rate is the interest rate that the Fed charges commercial banks for borrowing reserves at the discount window. Now, remember, federal funds rate is a market interest rate. If we plot federal funds rate against time, it's a market interest rate, so it's fluctuating. All the Fed can do is to set a target. Say, for example, if today the Federal Open Market Committee announced that they are going to increase the federal funds rate target. Originally, federal funds rate is fluctuating around the original target. The Fed cannot set federal funds rate, but they set a target and try to influence the market federal funds rate so that the market federal funds rate will go up. How can they do that? If you are a farmer, you want to increase the price of the apples. What would you do? Do you put more apples into the market or fewer apples into the market? The answer is you withdraw some apples from the market, right? Therefore, in order to increase the price of the reserve, the Fed would want to withdraw reserves from the market. How can the Fed withdraw reserve from the market? The answer is the Fed sells Treasury bonds, government securities, and the banks will have to pay. In that way, the Fed withdraw reserves from the banks. If the farmer withdraw some apples from the market, what happened to the price of the apple? Goes up. When the Fed withdraw reserves from the bank, what happened to the price of the reserve? Goes up. What is the price of the reserve? Federal funds rates. And what do we call that? Fed sells Treasury bonds in the open market. This is called open market sale. Therefore, when the Fed sells government securities, commercial banks paid with reserves, then federal funds rate goes up. On the other hand, when the Fed conducts an open market purchase, this is open market sale. When the Fed conducts an open market purchase, remember, purchase what? Purchase government bonds. When the Fed buys government bonds, the Fed has to pay, right? So they pay, they inject reserve into the banking system. So reserve increases. Therefore, federal funds rate goes down. Let me say it again. If the farmers put more apples into the economy, the price of apple goes down. So when the Fed buys government securities from the commercial banks, the Fed has to pay reserve. So reserve level increases, federal funds rate goes down. If the Fed sells, open market sells government security, the bank has to pay. So the Fed withdraws reserve from the market. Therefore, reserve decreases and the price of the reserve goes up. What have we done so far? At the beginning of chapter 8, we said that we want to use demand and supply analysis to analyze the market for money. The variable on the x-axis is quantity of money. The variable on the y-axis is the price of money, that is, the interest rates. Then before we draw the money demand and money supply curve, we have to know who the demanders are and who the suppliers are. So we want to draw money supply curve first. So who are the suppliers? Who are the money suppliers? The answer is the central bank and the commercial banks. So we went through the details of how central bank create monetary base, and then commercial banks use monetary base to create more money. So now we know who the money suppliers are. We are ready to draw the money supply curve. So at any given time, it is the Fed that uses the monetary policy to determine the total quantity of money supplied in the economy. So it's a monetary policy tool. It is independent of the interest rates. Therefore, at any given time, money supply is a vertical line. Vertical at the point where the current money supply amount in the economy is, and that is determined by the central bank, the Federal Reserve Bank. Now, money demand. So who are the demanders? The answer is you, me, the consumers. We demand money to buy goods. Okay? So now we want to draw the money demand curve. Now you are the demander. Okay? When interest rates, say for example, is 10%. What is your money demand? What is your quantity of money demanded? Remember, keep this in mind. What is the money that we're talking about here. Money in this chapter is defined as 100% liquidity. So what has 100% liquidity? The answer is currency and deposits. That is the dollar bills in your pocket and your checking account balance. What's the most important characteristic of these two items? The answer is your cash and checking deposit does not pay any interest. Therefore, money here is the money that doesn't pay any interest. Therefore, if interest rate is 10%, say for example, you want to keep $10 in your pocket and the checking account. Now, when interest rate is lower, are you going to keep more money in your pockets or less money in your pockets? To understand this, you have to know that because the money here does not pay interest, therefore interest rate is the opportunity cost to hold money in your pockets. Why? Because if you hold this money will not earn you any interest. The alternative is if you decrease your holding of money, you can put those money in your savings account, in your CD account, in your stock account to earn a higher interest. Therefore, when interest rate is high, you're going to put more money into interest-bearing accounts and less money in your pockets because the money in your pocket does not earn any interest. When interest rate is low, the opportunity cost of holding money is lower. Therefore, for convenience, you want to keep more money in your pockets. So it's convenient for you to spend your money. You don't have to withdraw money from your savings account and even get some penalties from your savings account. Therefore, when interest rate is low, for convenience, for liquidity, you are going to hold more money in your pockets. Therefore, money demand curve is just like the regular demand curve that is downward sloping. So now we have money demand curve and money supply curve. What's next? The answer is we find the equilibrium. So here is the equilibrium. And this is the equilibrium amount of money in the economy, which of course is the money supply that is determined by the Fed. And the equilibrium interest rate is here, say 5%. Therefore, the market for money can determine the market interest rate. What's the next question? Of course, what causes a movement and what causes a shift? Now first, what causes a movement on the money demand curve? Again, there's only one thing that will cause a movement along the curve. That is the variable on the y-axis. Here, interest rate. So what causes a movement? The answer is a change in interest rate will cause a movement along the money demand curve. Why? Because that's exactly how we drew our money demand curve. Right? Therefore, the change in interest rate will cause a movement along the demand curve, the money demand curve. And what causes a shift? Two words. Anything else. Anything else that changes the money demander's behavior will cause a shift of money demand curve. We have been doing the demand and supply analysis many times, so now you should be familiar with this. So what are those things that changes money demander's behavior? Remember, now you assume you are a money demander. So interest rate will cause a movement. The change in the variable on the y-axis will cause a movement along the money demand curve. Anything else that changes money demander's behavior will cause a shift. What are they? First, the price level. The overall price level in the economy will change the money demander's behavior. Why? Let's use a simplified example. Suppose that there is only one good in this economy, Whopper Jr. Say for example. Therefore, the price level of this economy is the price of the Whopper Jr. Say for example, if you have to eat one Whopper Jr. to survive the day, the price of Whopper Jr. is 99 cents. Then how much money do you have to keep in your pockets to buy this Whopper Jr. and eat it and survive the day? The answer is you keep 99 cents in your pockets. So your money demand is 99 cents. Now today, Whopper Jr. goes home and Whopper Sr. grabs Whopper Jr. and beat him up, saying, "How can you sell yourself at such a low price? You are a shame of our family." Therefore, the next day, Whopper Jr. increases its own price to $1.99. So now, the price of Whopper Jr. increases to $1.99. Again, you have to eat one Whopper Jr. to survive the day. Now, how much money do you have to keep in your pockets? The answer is $1.99. Therefore, when price level increases, you keep more money in your pockets. Therefore, money demand increases. Therefore, money demand curve at any given price, you keep more money in your pockets. Therefore, money demand curve shift to the right. The second factor that changes money demander's behavior and therefore shifts the money demand curve is income. Why? Again, let's use a simplified example. Today you are a college student. You eat Whopper Jr. for lunch, and the price of Whopper Jr. is 99 cents each. So how much money do you have to keep in your pockets? The answer is 99 cents. But now you graduate, you got a job, you got a salary. You have a higher income. So you don't eat Whopper Jr. anymore. Now you eat steak for lunch. And the price of a steak is, say for example, $7.99. Then how much money will you keep in your pocket to survive the day? The answer is $7.99. Therefore, when income increases, money demand increases. So when income increases at any given price, you keep more money in your pockets. Therefore, money demand curve shift to the right. The third factor that shifts the money demand curve is the financial innovations. Say for example, ATM, credit cards. When we didn't have ATM, when you need cash, what do? You go to the bank to withdraw money. And you have to spend the time and effort to go to the bank to withdraw your money. That is not convenient. Therefore, you would keep more money in your pockets when there was no ATM machine. Therefore, this financial innovation, the innovation of ATM, will decrease your money demand. Credit card. Again, if you don't have credit card and you need cash, what do you have to do? You go to the bank to withdraw money. But because of credit card, you don't have to go to the bank so often. You only need to pay your credit card once per month. Therefore, the financial innovation of credit card will also decrease the money demand. In that case, money demand shift to the left. Now, how about supply curve? What causes a movement along the supply curve? The answer is only one thing, that is the change in interest rates. Anything else will shift the money supply curve. Anything else that changes money suppliers' behaviors will shift the money supply curve. Who are the suppliers? Central bank and the commercial banks. So when their behavior changes, money supply curve shifts. Therefore, the Fed, the money supplier, if the Fed conducts an open market sale, remember what is open market sale? Sell treasury bonds to banks. Therefore, banks pay the central bank reserves Therefore, the Fed or the central bank withdraw reserve from the market. Therefore, commercial banks' ability to create money is less. Therefore, money supply decreases. Money supply curve shift to the left. The new equilibrium will be here. So interest rate increases. If the Fed conducts an open market purchase, what is open market purchase? The Fed buys treasury bonds from banks. Therefore, the Fed pays reserve to the banks. Therefore, the Fed injects reserve into the economy. Therefore, reserve increases. Commercial banks have more reserve to make loans. Therefore, they can create more money. Therefore, money supply shifts to the right. Equilibrium interest rate decreases. All right, now let's conclude this chapter with a summary. Throughout this summary, you have to use everything that you have learned in this semester. So let's go through this process. Every 6 weeks, Federal Open Market Committee has a meeting, right? What is their decision? Their decision is on the federal funds rate target. Say, for example, in this meeting, the Fed decides to lower the federal funds rate target. So if this is federal funds rates, you plot it against time. The original target is this. Therefore, federal funds rate is fluctuating around the target. Now the Fed decides to lower the target. Again, federal funds rate is a market interest rate. The Fed cannot set the federal funds rate, because federal funds rate is determined by the demand and supply of reserves in the federal funds market by the commercial banks. The Fed can only set the target and then use open market operations to influence the federal funds rate, the market federal funds rate. So what does the Fed want to do now? The answer is they want to lower the federal funds rate. They want to lower the federal funds rate. They want to lower the price of the reserve. If you want to lower the price of the apple and you are a farmer, what do? You supply more apples into the economy, right? When you put more apple into the economy, the price of apple will go down. Therefore, when the Fed wants to lower the price of reserve, what do they have to do? They supply more reserve into the economy. They inject more reserve into the economy. How can they do that? They conduct an open market purchase. They buy treasury bonds from the commercial banks, and then they pay reserve to the commercial banks. They inject reserve into the economy. Therefore, the price of reserve goes down. And because they inject more reserve into the banking system, commercial banks can use more reserve to create money. Therefore, money supply increases. When money supply increases, interest rate goes down, which is consistent with this graph. When the Fed conducts an open market purchase, market federal funds rate goes down. from the market of money, same thing. Equilibrium interest rate goes down. In Econ 3200, Money and Banking, we will learn that when short-term interest rate goes down, long-term interest rate will go down as well. And this long-term interest rate, a lower long-term interest rate, is very important because long-term interest rate is related to some durable goods like cars, refrigerators. When you want to buy those consumers goods, durable goods, you borrow a longer term loans. Say if you want to buy a house, you get a mortgage. Therefore, when long-term interest rate falls, 30-year mortgage rate falls, you have the incentive to buy a house. Therefore, your consumption increases. And when interest rate falls, firms' cost of borrowing money is lower. Therefore, they are willing to invest more. So consumption increases, investment increases. At the same time, because our interest rate is lower, people do not want to hold our currency because we pay a lower interest rate relative to the foreign country. Therefore, people are going to sell our dollar and buy foreign currency. When people are doing that, dollar depreciates. And according to our definition, exchange rate falls. When dollar depreciates, it's cheaper to buy US goods now, therefore our export increases. People want to buy our goods because our goods are relatively cheaper now because our dollar depreciates. And we buy less imports because our currency depreciates, foreign goods becomes relatively more expensive because the value of our dollar decreases. If we want to use our dollar to buy foreign goods, it's more expensive. Therefore, the net export increases. So C increases, I increases, X minus M increases. Remember, aggregate expenditure is C plus I plus G plus X minus M. So when C increases, I increases, X minus M increases, aggregate expenditure increases. Therefore, aggregate demand increases. Aggregate demand curve shift to the right. Equilibrium goes from here to here. Therefore, real GDP increases. Real GDP increases. Price level increases. So to understand this, you have to understand everything that we have been talking about this semester. In your textbook, there's a chart like this. Alright? We just went through the example here. Now, let me do it all over again using the opposite example. Now, the Fed increases federal funds rate targets. Originally, target is here, now target is here. Originally, federal funds rate, the market interest rate fluctuates around here. Now the Fed sets a higher target. Therefore, the Fed wants to use open market operation to influence the federal funds rate so that federal funds rate will go up to reach the target that the Federal Reserve Bank sets. Now, how can you increase the price of the reserve? If you are a supplier, how can you increase the price of the apple? The answer is you withdraw apples from the market. Then the price of apple will go up. Therefore, if the Fed wants to increase the price of the reserve, they have to withdraw reserve from the market. They want to decrease the reserve. When they want to decrease the reserve, what should they do? Open market purchase or open market sale? The answer is they conduct open market sale. Sell what? Sell treasury bonds to the banks. So the banks will have to pay with reserves. Therefore, the Fed withdraw reserves from the market. Therefore, federal funds rate goes up. When federal funds rate goes up, other short-term interest rate goes up. Exchange rate goes up. Dollar appreciate because our interest rate now is higher. People want to buy our dollar. Money supply increase. Money supply decreases because now reserve level is lower. Commercial banks' ability to create money is lower, therefore money supply decreases, interest rate goes up, just like this. Therefore, the long-term interest rate will also increase. Now the mortgage rate is high, the car loan interest rate is high, you're not going to buy a house, you're not going to buy a car. It's more expensive for firms to borrow money because interest rate is high, therefore investment decreases. And again, net export decreases because our dollar is more expensive now. Therefore, aggregate expenditure decreases. Aggregate demand shift to the left. When aggregate demand shift to the left, equilibrium goes from here to here. Therefore, real GDP decreases, price level decreases. That's what happened to the economy. Therefore, these are the effect of the monetary policy on the aggregate economy, that is, real GDP and the price level.